Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. The regulatory net continues to tighten around cryptocurrencies in India. The government has now brought the trading of cryptocurrencies and digital assets under the Prevention of Money Laundering Act. Last year, it had introduced a 30% income tax on gains made from crypto trading. Now the question is, will the latest move sound the death knell for the industry? Or is it a sign that the government is willing to give regulation a try instead of outrightly banning cryptocurrency? And how will this impact investors? Bhaswar Kumar brings you the answers.
Reserve Bank of India Governor Shaktikanta Das didn't mince his words when he spoke about private cryptocurrencies at the Business Standard BFSI Summit in December last year.
That if you try to regulate it and allow it to grow, please mark my words, the next financial crisis will come from private cryptocurrencies.
Das's statement was a reiteration of RBI's tough stance on private cryptos, in which it has called for their prohibition. It also came at a time when the industry was facing several headwinds, which turned 2022 into one of the worst years for it. A hawkish US Federal Reserve and a slew of scandals were some of them. On top of that, the budget for FY23 introduced a 30% tax on any income from the transfer of virtual digital assets, and an additional 1% tax deducted at source came into effect in July. At the same time, the government also clarified that by levying taxes, it was not making cryptocurrencies legal. The Enforcement Directorate also raided some Indian exchanges in 2022. Trading volumes collapsed across all Indian exchanges as the 1% TDS drove them from India to exchanges abroad. Coming to 2023, India, as the G20 president, is looking to drive the global narrative on the dangers of cryptocurrency. Officials in the government and the RBI have argued that while there is a need for strong global regulations for private cryptocurrency assets, banning should be an option in certain cases. And in February, at the G20 meeting of finance ministers and central bank governors in Bengaluru, International Monetary Fund Managing Director Kristalina Georgieva backed India's stance. Now, the centre has brought the trading of cryptocurrency and digital assets within the ambit of the Prevention of Money Laundering Act, or PMLA. This means that any financial wrongdoing involving such assets can now be investigated by the Enforcement Directorate. The move comes even as the legislation to govern the crypto sector is still awaited. The activities that will be covered within the ambit of PMLA include the following: exchanges between virtual digital assets and fiat currencies, exchanges between one or more forms of virtual digital assets, transfer of virtual digital assets, safekeeping or administration of virtual digital assets or instruments enabling control over such assets, participation in and provision of financial services related to an issuer's offer and sale of a virtual digital asset. The definition of virtual assets includes cryptocurrencies and non-fungible tokens. So, will this latest move sound the death knell for the crypto industry? Or is it a sign that the government is trying to look at regulating cryptos instead of banning them outright?
The recent notifications by the Ministry of Finance give VDA platforms such as CoinSwitch the status of reporting entity under the PMLA Act of 2002. This means that VDA platforms are now mandated to undertake KYC, monitor and record all transactions and report to Financial Intelligence Unit as and when any suspicious activity is detected. Such rules are always applicable to banks, financial institutions, and some other entities such as intermediaries in securities market, real estate, etc.
I think it's definitely a net positive because it shows intention on part of the lawmakers to move away from their initial attempts to ban cryptocurrencies and now move towards regulation. There was a shroud of uncertainty when it came to crypto transactions earlier, and banks and financial institutions, dare I say, wanted to stay away from these transactions. But now, with regulatory certainty coming in the way of a recognition for these sort of transactions and regulation for these sort of transactions, I do believe systems and processes can be put in place for banks and financial institutions to get more actively involved in the process.
Also, how does bringing crypto assets under PMLA fit in with the RBI's tough stance on them?
Actually, the RBI position on crypto is very well known. I think what the government has done is that the government has taken a practical approach. They are not going to do anything very harsh on crypto. What they're saying is that, okay, while you are here, make sure that you follow the rules. And by the way, here are the rules. So these are two separate things. The RBI is entitled to its views, but the government has to go about doing its business of governance. And that's what you're seeing happen at this point of time.
Who will this move affect more, the exchanges or the investors? And what does it mean for the investors in particular? Especially since Seychelles-based cryptocurrency exchange KuCoin estimates that over 115 million Indians had invested in cryptocurrencies by June 2022. Consider that the number of demat accounts in India stood at 110 million in January 2023.
This is more of a back-end sort of a compliance. It's actually a hardcore compliance. So what this does is that the onus is completely on the exchange. What we have to do is that report suspicious transactions to the FIU and make sure that our KYC norms are watertight. So the end user is not at all affected by this. This is more of an operational issue. The user might not even come to know what is happening at the front end when he interacts with the exchange.
There isn't going to be an immediate impact on individual investors dealing with cryptocurrencies at an individual level. They may have to work with exchanges to have their KYC requirements and compliances in place. In the event any sort of further scrutiny happens at the hands of the enforcement directorate, the change in itself may not impact anything, but I would say that appropriate documentation would always be expected in these sort of scenarios from the enforcement directorate about the veracity of these transactions, the commercial intent behind these transactions, and a proper documentary record to avoid any sort of allegation that there was something surreptitious about these transactions in the first place.
Further clarity on the eventual fate of crypto assets in India may only emerge in October, when the IMF and the Financial Stability Board are expected to present a joint technical paper that will help in formulating a coordinated and comprehensive policy approach to such assets, especially since the centre is reportedly reluctant to table the bill governing the cryptocurrency sector in Parliament until there is global consensus on regulations.
Bringing cryptocurrencies under the regulatory umbrella might be followed by another regulatory change, this time from SEBI. The markets regulator is examining whether it should allow permanent capital vehicles or PCVs in India. Unlike regular private equity and venture capital funds, which have a limited life cycle, PCV can last in perpetuity. Famous investment house Berkshire Hathaway is one of its examples. So why does India not have its own Warren Buffett? And how will the investment scenario change if PCVs are allowed? Tushar Verma's report has more on this.
Investment in India, particularly through private equity and venture capital funds, has a time limit. According to SEBI rules, the investment funds must be liquidated in 7 to 8 years. Hence, investors mostly look for high returns in a short span of time. According to a report by a financial daily, SEBI is mulling to allow permanent capital vehicles or PVC. This will essentially allow asset management companies to stay invested in a company for several years or even decades. Investment through PVCs is a common practice in the USA. For example, Warren Buffett's Berkshire Hathaway has remained invested in Coca-Cola since 1988. Buffett has then bought $1 billion worth of shares. Although Berkshire Hathaway traded on the shares multiple times, it maintained Coca-Cola in its portfolio. As of 2022, Berkshire Hathaway had 400 million shares of Coca-Cola. The question here is, why doesn't India have propositions of permanent capital vehicles along the likes of Berkshire Hathaway?
Though the likes of perpetual funds like Berkshire and Fairfax have been in existence for long, apart from the two funds of IFM and JPM formed between 2004 and 2006, most other perpetual funds abroad came into existence post 2017. Floating of perpetual funds and fundraise globally has picked up momentum after July 2021. In that sense, India has not missed out much. India is an evolving market and AIFs have gained importance in India over the past 3 to 4 years. The next instrument to be considered by the fund managers and investors could be the perpetual funds.
There are a few structures available already in the market which resemble a permanent capital vehicle. So, for example, for the real estate space in the last few years, the SEBI has come up with real estate investment trusts. We call them REITs. And similarly, we have a product called Investment Infrastructure Trust, which is popularly called an InvIT. These are all listed vehicles and very akin to what is a permanent capital vehicle. What we don't have is a pure play SEBI registered permanent capital vehicle for holding investments in other companies. The option that we have under our regulations today is what is called a holding company, a deemed NBFC, which is regulated by the RBI. So it'd be interesting to see how the SEBI is looking to carve out a PCV structure so that there is no overlap with what the RBI already regulates.
SEBI's proposition comes at a time when doubts around alleged inflated valuation of companies, especially startups, are doing the rounds. More recently, the Supreme Court of India had constituted an expert panel to investigate if there are any irregularities in the securities market in light of the Adani Hindenburg case. If SEBI approves PCVs in India, it will allow asset management companies in the country to participate in patient and long-term funding. This means that AMCs will start investing in companies with good corporate governance practices and strong financials over a long period of time. So, how will the investment scenario in India change if SEBI allows PCVs within a regulatory framework?
For the concept of perpetual bonds to take off, we may need some regulatory changes in India in terms of investment patterns of long-term investors. Also, some fund managers wanting to invest in startups that can take long to turn valuable may opt for perpetual fund route rather than AIF, as they may not want to worry about liquidating their investments within the given life cycle of the fund in an AIF format, which is typically 8 to 12 years. Investors putting a slice of their wealth in a PCV would be betting on comparatively slower growth.
It would be much better, I would say. I think, there are certain industries which is looking beyond funding, beyond helping liquidity, beyond helping the management 7 to 10 years, which is right now, given in an alternative investment fund. If you look at the growth has been, phenomenal. 5-7 years growth in alternative investment has been roughly around 38%, right? That's amazing growth. Vis-a-vis what other, similar instrument in the country has seen roughly around 22-23%. Now, that will really gallop to a much bigger height, because then the pressure to exit by PE funds or venture capitalists is not there.
PCVs have been gaining popularity in recent years. Experts believe the time is right for the SEBI to explore PCVs, which can change the alternate investment fund landscape in India. AMCs may change the strategy by preferring PCVs over startups and look at high returns over a long-term period. It remains to be seen whether SEBI will finally allow PCVs, and if it does, what will be the regulatory framework.
India's march towards becoming an economic superpower comes at a cost, a rapid rise in electricity consumption. In February, the country's power consumption rose over 9% year-on-year. With summer ahead, analysts say the rising demand for power will fire up related stocks over the long term. While they expect solar-powered companies to benefit from the rising temperatures, poor rainfall might put hydropower and thermal power companies at a disadvantage. Tune into Lovisha Darad's report for more.
India's power consumption rose over 9% year-on-year to 117.84 billion units in February this year. The peak power demand, which is the highest supply in a day, too, rose 209.66 gigawatts in February 2023 from 193.5 gigawatts in the year-ago period. This rapid rise in power demand, which analysts anticipated to witness in March 2023, surprised street estimates and bolstered related stocks. In the past 1 month, shares of power companies like NTPC, Tata Power, Torrent Power, JSW Energy, ABB India Power Grid, and Siemens surged up to 17%. In comparison, the S&P BSE Sensex declined 0.2% during the same period. Going ahead, analysts believe upbeat economic activity coupled with sustained demand during summers will lift the fortunes of power companies. Antu Thomas of Geojit Financial Services expects power demand to rise 10% YOY to 230 megawatts by April 2023.
India's power usage increased by 9% YOY to 117.8 billion units in February 2023, as compared to 108 billion units in the same period a year ago. This is due to an increase in economic activity and a rise in temperature. We expect this trend to continue during the summer season. On the economic front, manufacturing PMI shows steady growth in February with 55.3%. and an enhanced probability of heat waves in most parts of the country during March, April, and May, the total demand can increase by 10% on a YOY basis to 230 megawatts in April. With the impact of El Nino, the demand can sustain during the year. To meet the demand, the power production from the existing plant, that is conventional and non-conventional sources, needs to pick up. To support this, the government has directed that thermal power plants that use imported coal to run at full capacity. The Railway Ministry had also said that they would be deploying 1.25 lakh wagons for the purpose of coal transportation, which would be helpful in meeting the coal inventory at the power plants. We remain positive on the sector, and on the stock front, we are positive on Tata Power and NTPC on a long-term basis.
In order to meet peak power demand, the government had directed all imported coal-based power plants to run at full capacity. With this move, analysts believe these plants can fully recover their high cost of generating and supplying power, which was adversely affected by increased international coal prices.
As per government data, electricity consumption grew by 9% year-on-year to 117.84 billion units in February 2023. This bodes well for the power generation companies as sustained demand improves their utilization, which is visible in the improving PLF data. Improved demand may also increase the tariff rates in the short-term market, which in turn will be profitable for companies having merchant capacities. The government has invoked Section 11 of Electricity Act 2003, directing imported coal-based plants to run at full capacity till summer based on the anticipated demand and domestic coal shortage. This will help imported coal-based plants to fully recover their high cost of generating and supplying power, which were adversely affected by the increased international coal prices and inability to pass on the price increases earlier. However, in case domestic or imported coal supplies are hindered, or El Nino phenomenon results in lower pace of economic activity and hence lower demand, then power companies may not end up benefiting. Hydropower companies may get affected in case of deficient rains, as their reservoir levels may deplete fast. Also, lower water availability may affect the PLF of thermal power plants, as water required for cooling purposes may not be available to the extent required. However, in such a case, solar-based power plants may do well due to higher availability of sunlight. Our preferred picks in the power sector currently are NTPC, Tata Power and Power Grid.
While peak summer may still be some time away, analysts remain bullish on the road ahead for the sector and suggest investors buy related stocks only from a long-term perspective. Meanwhile, as regards today, domestic markets will be swayed by the rupee movement, global cues and foreign fund flow action.
Meanwhile, in neighboring Pakistan, protests are erupting in cities because of prolonged power outages. February's retail inflation has soared past 31% and the Pakistani rupee has devalued by 30% during 2022. The country is staring at a sovereign default. Now, what is a sovereign default? We explain in our next segment.
According to the IMF, governments borrow to spend beyond what they can or want to raise through general taxation. They borrow when revenues are down and they have to pay for existing commitments. Governments also borrow to spend on infrastructure like building new highways and laying new railway lines. And they borrow money from both domestic and foreign fronts. At the domestic front, they borrow from banks, asset managers, or directly from households. And at the international front, they borrow from global capital markets, from governments, or from international organizations. So when the government fails or refuses to repay the full debt when it is due, it is called a sovereign default. And unlike companies, the governments cannot be taken to bankruptcy court for debt recovery. Like in April last year, Sri Lanka declared the country was suspending payment on most foreign debt. Later, several leading credit agencies said that the country has defaulted. Our another neighbor, Pakistan too, has been teetering on the brink of default for a while now. Its balance of payment crisis has reached to the level that the country is unable to pay for the essentials. There were reports of cargoes full of essentials like medicines waiting at ports as the authorities were unable to pay the bill. State Bank of Pakistan had said that by February 3rd, the country was left with only about $8.5 billion of foreign exchange reserves. The country is currently holding talks with the IMF to save its sinking economy. When a country defaults of foreign debts, it tries to negotiate to pay back by restructuring the debt. In that case, creditors will have to take haircuts, slash interest rates, and bear some of the losses. But in extreme default conditions, like in Sri Lanka, the foreign creditors will often take much harsher steps, like pursuing claims on defaulted countries' assets. Last year, Sri Lanka had to hand over Hambantota port to China on lease for 99 years. A sovereign debt default has multiple consequences on the country's economy. A default may lower the net asset value of bonds related to the defaulted debt. On the other hand, it can also attract more distressed debt investors who are likely to capitalize the lower prices of the bonds. Therefore, a sovereign default leaves both winners and losers.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
According to a report in The Guardian, more than 800,000 Pakistanis have left the country last year in search of better economic prospects. That's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.